Welcome to Corporate Management Control, a crucial process for the success and sustainability of businesses. In this presentation, we will cover efficiency, effectiveness, and productivity, as well as key topics including budgeting, performance measurement and monitoring, the role of accounting, company costs and revenues, planning, reporting, organizational performance analysis, strategic business decisions, and the benefits of management control. Business efficiency, effectiveness, and productivity are achieved through strategies and practices designed to optimize performance. This includes defining what efficiency, effectiveness, and productivity mean, implementing strategies to improve each area, utilizing planning, monitoring, and evaluation, leveraging technologies, nurturing a positive corporate culture, and investing in continuous education. These elements collectively bring significant benefits to any organization. Efficiency is the ability to achieve maximum results with minimum effort, focusing on optimizing the use of time, money, human, and material resources. While efficiency targets resource optimization, effectiveness is about achieving desired outcomes. Improving efficiency involves reducing waste, optimizing processes, and adopting technologies like automation and artificial intelligence. A corporate culture that values efficiency motivates employees to seek continuous improvement, ensuring both efficiency and effectiveness for long-term success. Effectiveness is about achieving the objectives set by an organization. It requires clear, realistic, and measurable goals, strategic planning, and ongoing evaluation. Effectiveness is influenced by resources, team skills, communication, and adaptability to change. Effective management relies on accurate data, performance metrics, and a collaborative work environment. Continuous assessment and flexible strategies ensure that organizations remain aligned with their broader objectives and can adapt to challenges as they arise. Productivity measures the amount of output generated relative to the input used. It reflects how efficiently resources are transformed into goods and services. High productivity indicates efficient processes and effective use of resources, while low productivity may suggest inefficiencies. Improving productivity involves process optimization, adoption of new technologies, continuous training, and smart management of time and resources. The goal is not only to produce more, but to produce better, sustainably, and with a positive impact. To improve efficiency, companies can automate repetitive processes using advanced technologies, freeing up employees for strategic tasks and reducing errors. Staff training is equally important, as it enhances skills and overall productivity. A well-structured training program should be tailored to company objectives and use innovative methods like e-learning. Investing in training not only boosts company performance, but also fosters personal growth and a motivating work environment. Improving effectiveness starts with setting clear, measurable goals using the SMART framework: specific, measurable, attainable, relevant, and time-bound. Team involvement and effective communication help align everyone with company objectives. Constantly monitoring progress and adapting goals when necessary ensures the company remains effective in achieving its targets. Training also plays a role by developing essential skills and fostering a positive, engaging environment. Implementing advanced technologies, such as IoT, AI, robotics, and cloud computing, is essential for improving productivity. These innovations enhance efficiency, flexibility, and open new business opportunities. Creating a collaborative work environment where employees share ideas and work towards common goals is equally important. Encouraging open communication, regular team activities, and mentorship programs strengthens team cohesion and drives productivity. Effective planning is fundamental to improving efficiency and effectiveness. It helps define short and long-term goals, identify growth opportunities, optimize resource use, and adapt to changes in the external environment. Involving employees in planning increases motivation and operational efficiency. Well-structured planning clearly communicates the company's vision, aligns stakeholders, and prepares the organization to achieve its strategic objectives. Monitoring business performance is essential for identifying areas for improvement and ensuring strategies are effective. Regular evaluation provides an objective measure of progress toward business goals, reveals trends, and supports informed decision-making. This process fosters a culture of accountability, enables timely adjustments, and guides professional development, all contributing to the company's adaptability and long-term success. Project management software and marketing automation tools are vital for increasing business efficiency. Project management platforms streamline planning, execution, and tracking, while automation tools save time, reduce errors, and personalize marketing efforts. Adopting these technologies can boost productivity, improve internal communication, and provide data-driven insights to guide business growth. Customer relationship management, CRM, systems and data analytics are key technologies for improving effectiveness. CRMs centralize customer information, automate tasks, and enable personalized service, increasing satisfaction and loyalty. Data analytics helps organizations make informed decisions by identifying patterns and trends, predicting customer needs, and evaluating business operations for continuous improvement. Online collaboration tools and time management apps are essential for boosting productivity, especially in distributed teams. Tools like ClickUp, Google Drive, Trello, Slack, Microsoft Teams, and time tracking apps help organize tasks, track time, facilitate communication, and enhance team efficiency. Selecting the right combination of tools tailored to business needs can turn time management into a competitive advantage. Promoting a positive corporate culture is essential for efficiency and productivity. A supportive environment improves morale, encourages collaboration, and increases satisfaction and retention. Recognizing achievements, providing growth opportunities, and fostering open communication create a motivating workplace that drives creativity and innovation. Investing in continuous staff training is vital for maintaining high effectiveness and adapting to market changes. Ongoing training updates skills, supports innovation, and increases motivation. Initiatives like Italy's New Skills Fund 2024 and reskilling practices help companies stay competitive, while skills certification and upskilling ensure employees are prepared for future challenges. Efficiency brings significant benefits, including reduced operating costs and improved customer satisfaction. Streamlining processes and optimizing resources lead to leaner operations, increased loyalty, and better financial sustainability. By continuously measuring and improving key indicators, companies can maintain excellence in customer service and overall business performance. Effectiveness enables companies to achieve strategic objectives and increase market competitiveness. Clear strategic planning, adaptability, and continuous improvement help businesses anticipate challenges, optimize performance, and remain flexible in a changing environment. Embracing digitalization and analyzing needs and goals are essential for maintaining competitiveness. Higher productivity results in greater profitability and improved employee morale. Efficient processes reduce costs and increase capacity, while investing in innovation, training, and process optimization strengthens competitive position. Recognizing and rewarding achievements fosters a positive work environment, driving organizational well-being and success. Monitoring business performance involves analyzing economic and financial results to support strategic decisions. Key activities include measuring KPIs, cost analysis, strategic planning, benchmarking, and risk assessment. These processes enable data-driven decisions, identify opportunities and risks, and ensure financial reporting and continuous improvement. Measuring economic and financial results provides a clear picture of a company's health. Analyzing balance sheets, income statements, and cash flows helps identify strengths and weaknesses, monitor liquidity, and measure ROI. Accurate measurement supports strategic planning and ensures long-term sustainability by aligning KPIs with strategic goals. Monitoring business performance is critical for evaluating strategies and optimizing processes. Using targeted KPIs helps measure the effectiveness of implemented strategies, align objectives across departments, and promote collaboration. Transparent KPI sharing and regular review ensure continuous improvement and organizational success. Economic and financial information is essential for strategic decisions, investment planning, and resource management. An effective management control system evaluates performance, monitors financial balances, and supports budgeting and reporting. Proper financial management ensures stability, growth, and informed decision-making for the long term. Key performance indicators such as sales, profit margin, and return on investment are essential for evaluating business strategies. These metrics help measure revenue growth, profitability, and investment efficiency. Selecting relevant KPIs and analyzing these indicators supports strategic decisions and continuous process improvement. Measuring business performance helps identify trends, improve profitability, and guide strategic decisions. KPIs offer measurable data aligned with strategic goals, enabling companies to predict future trends and make data-driven decisions. This approach supports continuous improvement and sustainable business growth. Financial analysis software and performance dashboards are essential for monitoring and evaluating business performance. These tools integrate and visualize data from various sources, providing intuitive insights for strategic decisions. Selecting the right technology ensures scalability, ease of use, and effective performance tracking. Cost analysis is fundamental for understanding cost structures, optimizing expenses, and supporting strategic decisions. Techniques like activity-based, standard, and variable costing provide detailed insights into direct and indirect costs, improving financial planning and competitive positioning. Strategic planning relies on economic and financial data to define long-term goals, assess opportunities, and mitigate risks. A systematic approach aligns resources with organizational objectives, anticipates industry changes, and mobilizes resources efficiently for business growth. Data collection is vital for monitoring performance. Using KPIs, companies measure success, identify strengths and weaknesses, and make informed decisions. Analyzing results and reporting findings with clear summaries and visuals supports accurate evaluation, guiding strategic actions and continuous improvement. Benchmarking compares a company's performance with competitors or industry leaders to identify best practices and areas for improvement. This process supports continuous innovation, sets realistic goals, and enhances competitiveness by adopting successful strategies from various sectors. Identifying financial risks and exploiting market opportunities are critical for strategic management. Measuring and monitoring performance enables companies to develop risk mitigation strategies and seize opportunities, supported by assessment tools and ongoing consulting for effective decision-making. Financial reporting provides a comprehensive overview of business performance for stakeholders. It includes balance sheets, income statements, and cash flows, offering transparency, compliance, and insights for planning, risk management, and resource optimization. Basing business decisions on concrete data is essential for reducing risk and driving success. Data analytics highlights trends and opportunities, supports innovation, and guides resource allocation. Financial analysis informs strategic planning and ensures decisions are aligned with company objectives. Vertical and horizontal analyses of business data provide insights into financial structures and trends. Evaluating KPIs helps monitor progress, identify strengths, and detect emerging market and workforce trends, ensuring strategies are aligned with organizational goals. Accounting plays a pivotal role in management control by tracking costs, analyzing revenues, and calculating profits. It supports cost monitoring, revenue analysis, profit calculation, and provides essential information for informed decision-making and strategic planning. Accounting is the compass for companies, offering a clear view of their financial situation. It enables managers to make informed decisions, monitor performance, manage budgets, evaluate profitability, and plan strategically. Accounting ensures transparency and supports sustainable growth. Monitoring company costs through accounting ensures transparency and efficiency. Accurate records support financial statements and tax compliance. Revenue analysis, updated for recent accounting standards, and profit calculation provide stakeholders with a clear understanding of financial results, guiding strategic choices. Cost monitoring helps identify inefficiencies and optimize resource use. Effective cost management requires planning, monitoring, and innovation, supported by transparency and data analytics. This strengthens financial sustainability and stakeholder trust, enhancing the company's market position. Fixed costs remain constant regardless of production volume, such as rent and salaries, while variable costs fluctuate with output, like raw materials and direct labor. Understanding and managing these costs is crucial for financial planning and strategic decision-making. Revenue analysis helps companies understand their income sources, identify profitable areas, and inform growth strategies. By evaluating sales data, market trends, and internal processes, companies can set realistic goals and support sustainable expansion. Revenue from product sales, services, and investments are key components of financial performance. Accurate recognition and management of these revenues, following updated accounting principles, ensure transparency and support financial sustainability and growth. Profit calculation is the culmination of accounting, reflecting the effectiveness of resource management. Profits indicate financial health, guide strategic decisions, and support growth through reinvestment or dividends, motivating teams and stakeholders. Profits are essential for reinvestment and rewarding shareholders. Reinvesting profits strengthens equity and finances growth, while dividends reward investors. Decisions on profit allocation reflect company health and future prospects, supporting sustainable development. Management control uses accounting data to plan, monitor, and evaluate business performance. This continuous process aligns goals, supports cost analysis, investment evaluation, and risk management, ensuring companies adapt and remain competitive. Budgeting is the foundation for planning expenses and allocating resources strategically. Reporting, through KPIs, provides performance analysis, informs decision-making, and supports sustainable growth by aligning actions with business objectives. Businesses manage various costs, including fixed, variable, direct, indirect, production, and marketing costs. Effective cost management is crucial for maintaining competitiveness and supporting financial sustainability. Fixed costs do not vary with production volume and include expenses like rent, wages, insurance, and depreciation. Understanding fixed costs is essential for financial planning, pricing strategies, and maintaining stability. Variable costs change with production volume, such as raw materials, sales commissions, and shipping costs. Proper management of variable costs enhances flexibility and profitability, supporting operational adaptability. Direct costs are traceable to specific products or projects, while production costs include both direct and indirect expenses. Marketing costs cover activities like advertising and promotions, essential for brand growth and sales. Direct costs are expenses directly attributed to production, such as raw materials, direct labor, and machinery maintenance. Effective management and clear assignment of direct costs are vital for cost analysis and pricing. Indirect costs, or overhead, are not directly linked to production, but are necessary for business operations. Examples include rent, utilities, administrative salaries, and marketing. Managing these costs is crucial for financial strategy and profitability. Production costs encompass all expenses directly attributable to goods or services, including both fixed and variable costs. Proper allocation and management of these costs support financial planning and competitive analysis. Marketing costs drive customer acquisition and brand promotion, including advertising, promotions, and market research. Monitoring and optimizing these investments are essential for maximizing return and achieving business objectives. Effective cost management ensures business sustainability, maximizes profits, and maintains competitiveness. It involves optimizing resources, reducing waste, and enabling the company to respond to economic challenges while supporting growth and innovation. Company revenues include sales, services, investments, and extraordinary receipts. Understanding revenue types and their importance helps companies develop strategies to increase income and support financial growth. Sales revenue reflects money from goods or services sold, recognized when control passes to the customer. Investment revenue, subject to specific tax regulations, and extraordinary revenues, reclassified per current standards, are important for financial planning and reporting. Sales revenue, driven by product or service marketing, is the main income source for most companies. Analyzing sales margins and optimizing processes are key to maintaining financial health and supporting business growth. Consulting, maintenance, and training services generate significant revenue for companies. These professional services improve management, operational efficiency, and employee development, supporting overall competitiveness and growth. Investment revenues, such as dividends and interest income, provide additional income streams and support financial health. Diversifying revenue sources through investments reduces risk and strengthens resilience against market fluctuations. Extraordinary revenues, like asset sales, insurance reimbursements, and lawsuit gains, are non-recurring income sources. Their proper classification and understanding are important for assessing business diversification and financial stability. Revenue is essential for covering operating costs and reinvesting in growth. Increasing revenue signals business success, but must be analyzed alongside profitability and other financial indicators to assess overall health and sustainability. Market expansion, product innovation, and improving customer service are key strategies for increasing revenue. These approaches help diversify income streams, enhance market share, and strengthen customer loyalty, driving sustainable business growth. Strategic planning is vital for business success. It involves context analysis, objective definition, strategy development, implementation, and monitoring. Using structured tools and approaches ensures effective planning and execution. Business planning defines clear goals and strategies, anticipates market changes, and ensures operational continuity. Integrated with innovation and human resource management, effective planning guides companies toward lasting success. Business planning requires context and market analysis, strategy development, implementation, monitoring, and goal setting. Each stage ensures alignment with vision, fosters sustainable growth, and supports overall business development. Context analysis helps companies understand their environment, assess opportunities and threats, and evaluate internal resources. Tools like SWOT analysis identify strengths, weaknesses, opportunities, and threats, guiding effective strategy formulation. Setting short-term goals provides immediate milestones, while long-term goals drive sustainable growth. Both should be smart, specific, measurable, attainable, relevant, and time-bound, to ensure alignment with company vision and adaptability to change. Business strategy development must align with organizational objectives, consider available resources and capabilities, and anticipate market trends. Collaboration, communication, and continuous evaluation are essential for successful strategy implementation. Effective resource allocation and staff training are core to implementing strategic plans. Optimizing people and other resources, assessing training needs, and fostering internal communication supports successful execution and adaptability. Monitoring strategy implementation assesses progress, enables timely adjustments, and ensures alignment with goals. Continuous evaluation identifies areas for improvement, supports agile responses to market changes, and sustains long-term success. Project management software, market analysis, and financial reports are essential tools for business planning. They provide insights into project progress, market opportunities, and financial performance, supporting informed and strategic decision-making. Budgeting is a systematic process for planning and controlling financial resources. It involves defining goals, setting types and phases, understanding its importance and advantages, and avoiding common mistakes to ensure sound financial management. Budgeting is the process of planning and controlling an organization's financial resources. It creates a plan for income and expenses, aligns departmental goals, and provides a control mechanism to compare actual data with forecasts. Proper budgeting reduces financial stress, prevents waste, and supports long-term planning. The objectives of budgeting include planning future expenses, identifying areas for improvement, facilitating internal communication, and monitoring financial performance. Through careful budget analysis, organizations can set and achieve specific, measurable goals while optimizing resource allocation. Operating budgets estimate day-to-day revenues and expenses, supporting feasibility and resource allocation. Capital budgets evaluate long-term investments using tools like net present value and internal rate of return to maximize value and minimize risks. Analyzing income and expenses is central to budgeting, enabling effective resource planning and monitoring. The budgeting process includes preliminary analysis, identifying expenses and revenue sources, setting objectives, and monitoring performance to ensure financial sustainability. Budgeting ensures financial stability, prevents excessive spending, and aligns resources with strategic objectives. It supports incremental, activity-based, and zero-based budgeting approaches, emphasizing the need for constant progress monitoring and leadership involvement. Budgeting improves resource allocation, increases financial responsibility, and forecasts potential difficulties. It supports strategic planning, enables timely corrective actions, and involves all departments in creating a cohesive financial plan for sustainable growth. Financial management software, spreadsheets, and SharePoint lists automate budgeting, track expenses, and enhance collaboration. Integration with analytics and secure data management ensures effective resource planning and decision support for both businesses and individuals. Underestimating expenses and failing to update budgets can lead to financial problems, resource misallocation, and missed opportunities. Regularly reviewing and updating budgets ensures accurate financial management, supports growth, and maintains investor confidence. Corporate reporting involves collecting, analyzing, and presenting business data to inform strategic decisions. It covers various report types, benefits, instruments, and is essential for transparency and future planning within an organization.